Welcome to episode 16 of the ICT Mastery Mentorship. In this episode, we're going to be going over the break-in market structure, okay? The break-in market structure, the verbal definition is basically, this is what you're going to be using for your main shift, okay? This is like your first, I guess you could say, model or concept that you're going to learn that's going to be dealing off, the market reversing or shifting, okay? You've probably heard the word reversal a lot when it comes to retail side, but we can call it reversal, okay, or a shift. But I prefer calling it a shift in the market because that's what it's doing. It's going from bullish to bearish or bearish to bullish or up to down or down to up. Same thing. So if we can draw an anatomy of a breakup structure, it looks something like this. Let's say we got buy side liquidity up here. We can say right about there, right? That's buy side liquidity right along there. It's resting there. What price will do is you want to see price come up and purge liquidity. Bang, like come up right there and bang, liquidity purge, okay? Then, see that swing low there? You want to pay attention to the most recent or the latest swing low that's been formed, okay? And if we look here, that's that right there. That's that swing low. So if we can mark that out, that right there is your swing low. We can mark this as a short-term swing because you don't know what this means. You don't know exactly what this means, but don't call everything a short-term low because you may get others confused on what a short-term low and a swing low is. Okay, big difference. But anyways, going back into the anatomy of a break-in market structure. After price purges liquidity, this is a bearish example. Okay, let me put that up real quick. This is a bearish example. Okay, bearish. Okay, do I need to do that again? Example. Okay, bearish example of a market structure shift. And I don't know why I just did that again. Please, thank you. But this is a bearish example of a break-in market structure. Okay, price purges liquidity or buy side liquidity in this case. Then price comes down, breaks the low. Okay, so this right here creates the market structure shift or the break-in market structure. Okay, this is when price shifts. This indicates the shift. But for a valid shift for it to be a valid shift, it must do what? It must purge liquidity first. Because, for example, if liquidity was up here and it just broke that low doesn't mean anything. And this could probably be a liquidity run or some sort of liquidity purge. But this point over here, it didn't purge that. Okay? And actually, it doesn't even have to be something that's all the way over here. It doesn't have to be something all the way that's over here. It can be this right here. That can be a form of liquidity. That high right there, this right here. You see how it broke it and then came down? Yes, that works. I'm not going to say it doesn't, but yes, this works. So if we zoom in on this, let's try the bearish example over so you know that this is bearish. Price came out, took out this high or form of buy side liquidity right there. I don't know why it's like that, but whatever. Buy side liquidity, bang, we came up and we purged it. That's the first thing. We need to look for some sort of liquidity purge before we come back and break the latest swing. Okay, this right here is the latest swing. Because if you look, this is not the latest swing, okay? Because this swing was, after it. So this would be the latest swing, obviously. I don't have to explain it. You're smart enough to understand it. I'm sure you're smart enough. If you're here and even wanting to learn from me, then you're most definitely smart enough to understand this, okay? Price comes up and purges buy side liquidity. We come down, breaking the low, okay? Once it breaks this low, that's your shift, okay? That's your shift right there. When price breaks this low, the way you would enter off the break-in market structure, if you're using the break-in market structure for your entry, is that from the latest swing to the last swing that was created after the purge, which is, okay, let me explain that real quick. From the latest swing, which is right here, the latest swing, or the latest swing low, to the latest swing high after price purge liquidity, within that range, okay, and I'll draw that range for you just real quick. Within that range, which is here to here, I can remove the equilibrium. But from within that range, you want to look for a fair value gap within this range. So if we can delete this, right? And I can pull this over, and you want to see a fair value gap within this range, right? So you can say this is a fair value gap right here. What you want to see price do is if you're entering off this, remember, this is if you're entering off the break-in market structure, you want to see price come up into the fair value gap and then dump, okay? You can target this low here, add your liquidity run or your sell side liquidity run right there, and bang, there's your trade, We're going to be going over the bullish and bearish example of this, but I just did bearish because, you know, that was the first thing that came to my mind, the first instinct, okay? Instinctive behavior. But this is what it'll look like, okay? Now we're going to go over this in an actual example. So let's, you know, go ahead and backspace all of this. Give me a little second to, you know, just to backspace all this. Give me a minute. There we go. But I am recording this in a hotel, obviously. So if you hear anyone in the background, it doesn't matter. But hey, content is content. So if you're complaining, oh, there's people in the background, I can't hear what he's saying. Well, okay, that's on you. But on a real note, let's go into this, right? So look in here. Did price come and purge that high? It did. It actually did. But let's use this high for example. So we see that price is clearly, you know, bullish from here to here. It's clearly bullish. Okay. Price creates a high right there. See that? See that high right there? Okay. Price came and purged this high, or which is in the form of buy side liquidity. We went past it a little bit. Okay. Then we came back down and broke this low here. See that? That low right there. So what is this? When we purge a high and then we break a swing low, what is that? That's a market structure shift, a bearish market structure shift. So we can list this as BOS. That's like the what's the word? The initial for breaking market structure, this right here. And as we see here within this range, right, from the latest high or the highest high from the latest low, there's no fair value gap there, is it? This one is here, but is it within this range here? Is it within this right here? Is it within that? Nope. Because if we look, part of it is within it, part of it, but is all of it within it? No. So we don't use that. If you see that, you want to drop down to a lower time frame from which the break of structure occurs on. So if you look here, the break of structure occurred on the 4 hour, so we either want to drop down to the 1 hour, 30-minute, or if we have to go any lower than that, then yeah. If you don't find a fair value gap on the 1 hour, you go down to the 30-minute. If you don't find one on the 30-minute, you go to 15-minute, then 5-minute, then 3-minute, then 1 minute, and you know, it's simple. Okay, you would get it. But what is this? The 30th, 6 a.m. So we're going to drop down to the 1 hour, and we're going to go to October 30th. Here we are. All right, let's pay attention here. Pay attention. Lock on. Lock in, chat. All right. So as you see here, on the 4 hour, that's our breaker market structure right there. And then look, we have a fair value gap right there. See that? If I can even draw correctly, right there is the fair value gap you'd want to use if price came back up into it, of course. But clearly, price did not do that. It just, you know, said bye bye, you know, just, you know, ripped away. But if you really want to see for ourselves, we can drop down to the 30-minute and really see if there's a fair value gap there. Let's check it out. But remember, so if you want to enter off the fair value gap, price has to, you know, create the market structure shift, then come back up to a fair value gap, not come up to a fair value gap, then market structure shift. No, because that's not, you really don't know if the market is shifting if there's no shift. If there's no shift, you really don't know if the market is truly shifting, and we'll respect that fair value gap, right? So you have to look for a shift, a fair value gap within the latest low, which is here, to the highest swing after price purge liquidity, which is here. That's the highest swing. So latest low, okay, to the highest swing after price purge liquidity. That's your range there. Is there a fair value gap here? There is. There's a fair value gap here. But what's wrong with this fair value gap? Why am I criticizing this fair value gap? Because what I just said earlier, price must shift or break or have a shift in market structure before coming to the fair value gap. It came up to the fair value gap, then shifted. No. If you want to enter off of it, you need to look for a shift, then a rebalance to a fair value gap. But clearly that did not happen. Okay. But this is an example of, you know, a bearish market structure shift. And was it bearish? I would say so. I would say so. I personally would say so. I don't know about you guys, but me personally, I would say so. But let's go over some more examples here. There's probably one right around here. But hey, we're going to jump back on to the 4 hour just to make this easier for us. All right, so let's look over here, shall we? Oh, you don't know about breaker block. I can't expose you to that. But here we are. Another bearish example. So looking here, right, you're probably already 2 steps ahead of me. But price came up to this high right here. What is this? What is this, JJ? It's buy sell liquidity. Oh yeah, buy sell liquidity. Okay. So price purges liquidity. Price comes down, breaks that low, the latest swing low. That's the shift. Okay. Because we want to use the latest swing low. Okay. Not we don't want to use this low all the way down here for the shift. We want to use the latest swing low. Which one is that? This one right here. So swing low, bang, break and market structure occurs right there. Break structure, and then there's your fair value gap within the range. Right there. Does price come up into the fair value gap? No, it doesn't. Sadly not. Sadly not. But remember, like I said, you can drop down. You can drop down time frames. So let's really see here. Oh, there's another fair value gap, but is it within the range? Is it within the range I taught you? Nope, it isn't. So we can drop down even further. 30-minute. Another fair value gap. Is it in the range? Nope. 15-minute. Is it in the range? Nope. And 5-minute. Want to keep going? You want to keep going? Let's keep going. Uh-oh, look at that. See that right there? See, just keep dropping down. All you gotta do is just keep dropping down and you will find one. See? Told you. Just keep dropping down and you will find a fair value gap that's within that range. So let's check for ourselves. Look, let's just make sure here. Let's draw another box and see if it's here. So from that to that, is it within this big box here? Is that fair value gap within this big box? Let's see. Is it? What do you think? I think so. It is, okay? Let's not play babyish here. It is within that fair value gap. So once you see price come up to this fair value gap, there's your sell right there. Okay? And obviously you want to use other confluences to make sure the market structure shift is valid, but you don't know about that yet. So we're not even gonna, talk about that. But right there, is that a sell? Yeah, that is a sell, okay? You want to set your stop. Now, okay, now fair value gap, right? Because if you're entering up a fair value gap, I haven't taught you how to set your stops. Let's talk about that real quick. If you're entering up a fair value gap, here's how you can place your stop loss. If you're using like strictly a fair value gap and you want to just put your stop at a fair value gap, this is how you do it. Well, let's drag this over, okay? Right about there. So around here, the fair value gap forms within these three candles. 1, 2, 3. Want me to pull that up for you? I'll hide all the drawings, okay? It forms within 1, 2, 3. Okay, these are the three candles right here. These three big bearish candles, or as Grumpy calls them in my Discord server. If you know about Grumpy, you know. But Grumpy calls them Jason Love candles or Drake candles. If you know what I'm talking about, you know what I'm talking about. Or if you know, you know. We have these three large, gigantic candles here, and the fair value gap is right there. Okay. Now let's put the drawings back on. Okay. Now I just showed you that. Let's put the drawings back on. That's the fair value gap. This is our entry. Okay. Let's just let's do this. So if it's a bearish fair value gap, you can either use, if you're entering off a bearish fair value gap, you can either put your stop at the high of the second candle, okay, which is right here, or the high of the first candle, which is right here. What is your preference? You can use any of these points. It's your choice, okay? It's all your choice. Okay, whatever you would like to risk, that's all your choice, okay? But since you're entering off a bearish fair value gap, you set your stop loss at the high of the second candle or the high of the first candle. Not the high of the third candle, because you will get literally immediately stopped. Okay, come on, just be smart. But high of the second candle and high of the first candle. Those are your 2 points where you can set your stop. But like I said, it's your choice. Okay, over time of looking at the charts, you will see which one is best for you or which one you like personally. But for me, I like going with the second candle's high. Okay, it's better risk reward. It's more money. Okay, but obviously in the future you have to learn, like, is price going to respect? Is it really going to like bounce off of it? Okay, that's gonna be there's gonna be a point in time where you're gonna be like, okay, is price really gonna like bounce off of this? Okay, obviously, but where are you gonna target? Okay, where are you gonna target? So since the market structure shift or the break of market structure is on a 4-hour, we can take a 4-hour target. So we can reset our chart view and zoom in all the way to here. Like I said, this is a 4-hour break of market structure, so you can take a 4-hour target. You can either target this point of sell side liquidity, or you can target this undelivered fair value gap here. Just like I taught you, if there's an imbalance below a low, you can target that also. Right there, that fair value gap. So you can target this fair value gap here all the way down here. You can target the fill of it. Why not? So looking at that, that is a 19 risk to reward. Okay, you want to do that? You want to do the calculations on that? Let's pull up something real quick. Let's pull up the calculator, shall we? So let's say you put in $50. Okay, let's just think $50 times 19. You just made $950 from risking, $50. Pretty insane, isn't it? I would think so. If you caught a trade like that, oh boy, yeah, pretty insane, isn't it? And like I said, price. I haven't said this before, but price is fract. Okay, anything it does on the 4 hour, it'll do on the monthly. Anything that does on the 1 minute, it'll do on the 30 minute. Anything it does on the 15-year chart, it'll do it on the hourly chart. Okay, okay, it's fractal. Okay, it does it. It works on every asset class. You want to see? It works on stocks. It works on funds. It works on futures. It works on forex. It works on crypto. It works on indices, which is basically futures, and it works on bonds, and it works on options. Okay, where it works on everything. The stuff I'm teaching you, or ICT concepts, works on everything. Okay, understand? Okay, cool. Okay, cool. Just make sure gotta make sure we got that down before we continue. Gotta make sure we got a good bond here. But with all seriousness, let's go ahead and erase these drawings and find a bullish example for you, because I don't want to teach you just strictly bearish examples. All right, let's find an example here. Hopefully I can actually find one for you, because you were the one that's learning, correct? All right, let's see here. You see this? Are you looking? Are you paying attention? Okay, okay. Just making sure. So if we look here, price came below this low. Bang. Purged it. Okay, so what's that? Liquidity purge right down there. Liquidity purge. Or that's so sad liquidity being purged, okay? Latest swing high, because this is a bullish example now. So latest swing high. Boom, there's your breaker market structure right along there, wherever the breaker structure tool is. Okay. Now. Is there a fair value gap within this range? Within the range I've been teaching you? Is there something here? Is there a fair value gap anywhere? I mean, I don't see one. Well, actually, no, there is. Surprisingly, there actually is. Right there. Super small, but it works. Okay, if you don't want to use that super small fair value gap, sure, we can drop down to the hour. What is this? September 4th, we can drop down to the hour. And we can be like, all right, we don't want to use that small gap. We're just going to, go back and really find a gap that we can use. All right, so actually jumping down to here is actually way better. So this is the 4-hour breaker market structure here, so we can delete this. That's the 4-hour breaker market structure with the 4-hour liquidity purge. Okay, after we purged, or after we shifted, not purged, but I'm sorry, after we shifted, we had a fair value gap resting right here. Okay, so price shifted, it came down into the fair value gap. That fair value gap entry, after that fair value gap tap is your entry. So as soon as it goes into it, so right about there, okay, we can drag that over. Like me personally, I set my stop at the, for this example, since you're using a bullish fair value gap, let me go over this. Since you're using a bullish fair value gap, if you're using a fair value gap for your stop, you want to use the low of the second candle or the low of the first candle. Okay, you got it? Cool, easy. Me personally, for this, I always use the low of the second candle, or I always use the second candle for the stop. Okay. Now, since we're done with that, we can jump back on the 4-hour and look for a what? A 4-hour target. Where would our 4-hour target be, hey? Right there. Do you see where? Oh, where, JJ? Right along there. See that? Right there. That is my target. Buy side liquidity. We go ahead and drag that take profit up there. And bang, look at that. A 4 risk to reward, boy. You see that? A 4 risk to reward. Absolutely amazing, isn't it? It's absolutely insane. I'm flabbergasted over here. I'm absolutely flabbergasted. But on a real note, that is the bullish and bearish example of, a breaker market structure. But I hope you, learned what a breaker market structure is and how you can use it for a confluence and a entry. Actually, no. I might just cut that out there. But we're gonna go over, how to use this as a confluence. Okay. All right. Let's think here. Okay. This same example, right? We're gonna go over this again. Just this is quick before you go. I'm sorry for making this a little longer. I was already doing the outro and everything, but it doesn't even matter. Liquidity purge, right? Breaker market structure. Right there. That's the breaker structure. See that? Right there. Now we know that price has shifted, but what can we use for our entry? If you don't want to drop down to the lower time frames, or you don't want to use the breaker market structure, just simply don't want to do it. You Just like, man, I don't want to use the break of market structure. I just don't trust it, or any reasoning that you don't want to use the break of market structure as an entry. There's an order block there. See that? There's an order block there. So once price comes down into the order block, in which it did right here, it came above, then came down right there. So that's your entry right there. That's your entry on the order block right along there. You set your stop at the low of the order block, or you can set it at like a previous candle's low. Well, I personally would set it right there at that candle's low. Then you can set your target at that same target that we had, which is, right along there. And that's how you use it as a confluence. You don't have to use it as an entry. You can use it as a confluence. Like, okay, market's shifting. We had a liquidity purge. Now we got to break a market structure. That's good. Using it as a confluence is basically like, okay, we got this, we got that. And then, okay, we got to break a market structure, so that confirms it all. So, it's basically just confirmation. Okay, that's when I say confluence, just know that that's what I mean. I'm basically saying we're using it as a confirmation, or basically to influence our bias. Okay, that's all I'm saying. But on a real note, I'm going to be ending this episode here, and I'll see you on the next one. Peace.